I mean, I think the story arcs are pretty bullish right now. From the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive because it's a path for U.S. deficit to normalize. And I think, indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us that justify investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold.
Tom Lee, co-founder of Fundstrat Global Advisors, predicts that Bitcoin could reach $250,000 by 2025, positioning it as a top-performing asset over traditional investments like gold. His bullish outlook is influenced by several key factors. One major factor is the shift in the U.S. administration's stance on digital assets. The current White House has appointed leaders viewed as pro-business and supportive of cryptocurrency innovation. New chairs for the Securities and Exchange Commission, SEC, and the Federal Trade Commission, FTC, along with the new Secretary of Commerce, are expected to create a more favorable regulatory environment. This change could encourage broader cryptocurrency adoption and investment. Institutional investors are also playing a major role in Bitcoin's growth. Large financial institutions are increasingly involved in Bitcoin, adding legitimacy and stability to the asset. Additionally, Lee suggests that Bitcoin could become a strategic reserve asset for the US, driving global adoption as other countries follow suit. This reinforces Bitcoin's value as a store of value and a hedge against economic uncertainties, making it attractive to both institutional and retail investors. In a recent discussion with Real Vision co-founder and CEO Raoul, Lee shared why he's more optimistic than ever. From regulatory changes to advancements in AI and crypto, he outlines how investors can capitalize on these emerging opportunities. Stick around as we bring you insights from their conversation, and if you enjoy this video, don't forget to like, subscribe, and turn on notifications to stay updated. Your support helps us grow and deliver more valuable content.
Bitcoin actually had come up in several discussions when I was at JP Morgan, and John Normand, who was the head of FX at the time, had talked about it. He wrote several pieces about, he wrote one that we had a whole conversation around, our firm did, which is that he thought that Bitcoin could become a currency at some point. Now, I think the network value of Bitcoin was like 20 billion, okay? Which made it like a decent sized stock. But he was saying that it was obviously mostly for dark web and, illicit purposes. So I didn't think much of it, and I didn't even follow Bitcoin. But then we started Fundstrat. And then in 2017, I remember just, for some reason, I think I saw the price of Bitcoin again, and I was like, whoa, this thing just went 10x in just a few years. And so, I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Most people, I think, tend to think if something's gone up a lot, it's a bubble, but actually, in the equity world, a lot of times it's actually telling you something's real.
Particularly when it's a network. That's the big difference.
Yes.
Networks tend to do this much more consistently.
Correct. So with our not great understanding, we did spend about 4 months doing a research white paper on Bitcoin. It's exactly what you said. First, we found that if you just did a very simple two-factor model, which is the number of wallets and then activity per wallet, it explained over 90% of the rise of Bitcoin since inception.
Yeah, and it's a good approximation for Metcalfe's law. It's the best way I got of fitting Metcalfe's law to the network value.
That's right. And then, we realized that's exactly why social media networks created value. Because, the idea of eyeballs and someone being the customer, and then because it's free and you sell them out, that was a very new concept. So to me, I had already believed in this idea that you could create businesses digitally that didn't start with a factory. And so we published our first report on Bitcoin. It was around $1,000 though. But we said that by using the same two-factor model by 2022, it could be $25,000. And that was either saying it was going to be worth 10% of gold or the number of wallets were going to increase. I don't remember the whatever assumptions we used. And then when we published at the time, I did it more as like a thought piece. And of course, I was advocating for Bitcoin. We recommended 2%, but it wasn't something that we thought we would hang our reputation on. But it created immediate backlash for us with our institutional client, who became very angry that we were trying to pitch something that had no tangible value and was clearly just used for buying drugs. So we actually got famously fired by several well-known hedge funds. And but then I assumed we were probably onto something, because I figured if someone...
Yeah, that's right. When you see that reaction, it's probably right.
Yeah, because if someone hates it, they haven't done the work.
Yeah.
And so now it's almost 9 years later, eight years later. And Bitcoin's obviously done really well.
So what's your framework for understanding the year ahead, next year? Just give me your data dump of, what are you looking at, what's interesting for you, how the macro plays out or the markets play.
I think the story arcs are pretty bullish right now. From the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive, because it's a path for U.S. deficit to normalize. And I think, indeed, animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us, that justify investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is a demographic story. I can send you some charts later, but if we look at the number of people aged 30 to 50 in the US, that's actually been steadily rising since 2009. It actually went positive in 2016. And what I mean by that is the number of people aged 30 to 50 matters in an economy, because they're the ones that are driving both credit consumption, but also productivity, innovation,
and investment. In the end, I think all of macro is just demographics. By the time, if you do enough work, go deep enough down the rabbit hole, the one monster factor of all is basically demographics.
And then there's a contrast, because as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the US tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness.
Like Pal, Lee emphasizes the transformative power of artificial intelligence on the global economy. He believes AI is not just a passing trend, but a powerful driver of real demand across industries. Lee has made bold predictions about NVIDIA, a leading player in AI technology, forecasting that the company could see a tenfold revenue increase within the next decade, potentially reaching $1 trillion. This reflects his confidence in the massive growth potential of the AI sector. Beyond individual companies, Lee views AI as a catalyst for broader economic productivity. He argues that integrating AI into various sectors will drive efficiency, spark innovation, and fuel substantial economic growth. This aligns with his broader market optimism, where AI is a major structural force shaping the future economy. Lee's stance on AI is clear. He sees it as a fundamental driver of economic transformation, with the potential to revolutionize industries, improve productivity, and create significant investment opportunities for years to come. Let's dive back into the conversation to explore these insights further.
People who are going to call the top in data center demand have never really experienced industrial cycles, right? Because the cycles actually are going to extend until return on invested capital is well past negative. And I would be very surprised if we're already reaching that saturation now, because we know that any model today would have improved capabilities if you improved computing power or capacity. So we aren't even experiencing the negative side of that utility yet. So I think that it actually would still argue that you need to be investing more capital. And I know, like when you look at percentage of GDP, I mean, look at what happened with China when direct private investment, it got to 40% of GDP. And that lasted years before you had overcapacity in China. So I don't know how we're even at saturation today in AI, but that's just in broad strokes. So I agree with you. I think there's still a big runway ahead. I've got two simple analogies to share that I think we should be looking for in AI. So we just published a study looking at the wireless fiber boom and when the stocks peaked relative to capital spending. And many people, so let's say it was a 20-year CapEx cycle for fiber and wireless. The stocks relative to the broad market peaked 8 years into the cycle. So in other words, like halfway into the cycle, the market will suddenly say enough capital has flowed into the space that they're market performers. However, in that now in retrospect, the 25-year look back, one industry in wireless pulled away from everything. Two did. The first one is the tower industry. It has produced better returns than handset, chips, carriers, spectrum owners, the towers, and it's a boring business that grows in a unit with demand. The second, of course, was Apple came along, but in 2007, so 13 years into the industry and after the industry's stocks all peaked, Apple came in and essentially gobbled up the economics of the ecosystem. So I think that in AI, it'll pay to look for the tower equivalent and the next iOS that'll come out on top of everything. But I think the second thing that's going to be important is that you just described it. AI is infinite workers with PhD qualifications.
Today. Don't forget, in 2 years' time.
Yeah, it'll be super intelligent, right?
Super intelligence. Something we've never had before.
Correct. And yet these super intelligent entities have to eat pizza. And what I mean by that is like the best performing stock in the last 25 years is Domino's Pizza, because everybody has to eat. So if you could find the pizza of the AI worker, so that's not the infrastructure, it's what you have to feed the worker, that's another moneymaker. And I don't know what that is going to be.
So I've got two thoughts on that. Obviously, one is the energy flywheel, right? If you're feeding AI, it's going to be probably something to do with the energy mix and how that's delivered and what. And I don't know, again, because the energy grid is going to get reconstructed and changed anyway. The other one that I've come up with is we are so digital now. We're going to become more digital. Our roles in whatever a workforce is or the economy is going to change. But tomorrow will be more digital than today. That is a fact, and that is not going to stop for the rest of our lifetimes. So it's going to cause an equal and opposite reaction. Somewhere within this, tangible experiences become premium experiences. And, if you look at the rise of LVMH, there's something in that story which is equivalent to your pizza, but the luxury pizza. Somewhere within this is going to be an equal and opposite story that's going to be immensely valuable to us as humans.
Lee draws compelling parallels between today's AI boom and the early days of wireless and fiber networks. Just as companies like Apple and the tower industry emerged as major winners after years of investment, the biggest players in AI may still be emerging. The key question is, who will be the Apple of AI, and what industry will quietly generate long-term wealth? Lee also highlights an essential point: AI needs resources to function, just as humans need food. Identifying what fuels AI's growth, whether it's energy, infrastructure, or new industries, could unlock the next major investment opportunities. As AI advances towards superintelligence, its economic impact may be even more transformative than we imagine. And despite recent volatility in the crypto market, Lee remains bullish on Bitcoin. Raoulpal echoes this optimism. In a series of posts on social media platform X, Pal explained that the recent dip in crypto prices is linked to global liquidity shifts. He urges investors to stay patient, predicting that improving financial conditions will drive crypto prices higher. Pal compared the current correction to a similar one in 2017, caused by a strong US dollar and rising interest rates under Trump's administration. Just as those conditions eventually reversed, he believes today's environment will improve, allowing Bitcoin to resume its upward trajectory. As the economic cycle advances and indicators like the ISM Manufacturing Index rise, Pal predicts that crypto prices will follow. His advice? Patience and less drama as the market continues to develop. What do you think? Will AI and Bitcoin dominate investment themes over the next decade? Share your thoughts in the comments below. If you found this video insightful, be sure to like, subscribe, and hit the notification bell for more deep dives into the future of finance and technology. Thanks for watching, and we'll see you in the next video.